Welcome to the Deep Dive. Today we are really digging into Alphabet's 2024 performance. We're using their official Form 10K annual report as our guide.
That's right. It's the definitive source.
Think of this as your roadmap to
Yeah.
understanding this tech giant. I mean, this scale is just massive, roughly a $2.2 trillion market value for non-affiliate shares back in June.
Wow. It really is staggering.
So our mission today is to unpack all that data from the 10K, pull out the key insights on their financial health, their strategy, basically what you, the learner, need to know.
Sounds good. And the best place to start, I think, is how they actually structure the business. It helps make sense of the numbers later.
Okay, lead the way.
Well, Alphabet basically breaks things down into three main parts: Google Services, Google Cloud, and then this category they call Other Bets.
Other bets.
Yeah.
Sounds intriguing.
It is. We'll get to that. But each segment, makes money differently, has its own growth plans, its own challenges. Understanding these pieces really helps see the whole picture.
Makes sense. So let's start with Google Services. My understanding is that's the real engine room, revenue-wise.
Absolutely. The report is clear: over 75% of their total revenue in 2024. That came from online advertising.
75%.
Yep. We're talking ads on Google Search, YouTube, their network properties. It's the core.
And they're not just sitting back, right? The report mentions investments in ad measurability.
Exactly. They're constantly investing there. Advertisers need to see what they're getting for that money. So improving how they measure ad effectiveness is crucial. It's how they keep that core business strong. Digital advertising is always evolving.
Right. But it's not just ads in Google Services anymore, is it? I saw mentions of subscriptions, platforms, even hardware like Pixel phones.
That's a key point. They are definitely diversifying within Google services. You've got subscriptions like YouTube Premium, YouTube Music, TV, even NFL Sunday Ticket now, plus Google One storage.
And Google Play.
And Google Play, yeah. App sales, in-app purchases. And then the hardware side: Pixel phones, smart home devices, wearables.
That other revenue category saw a big jump, didn't it? Something like $5.7 billion more than 2023.
It did. And the report specifically calls out YouTube subscriptions as the biggest driver of that increase, with Google One following.
So subscriptions are really picking up steam.
They are. It's a smart strategy. It provides a more predictable revenue stream compared to just advertising.
Yeah.
But that device market, wow, it's tough.
Super competitive.
Incredibly. You've got major players, constant innovation needed. It requires huge ongoing investment just to stay in the game, let alone gain significant share.
And this ties into something else mentioned, the evolution of ads, especially with AI and search. They said the initial focus was user experience, not monetization straight away.
Yeah, that's the long game approach. If AI makes search genuinely more helpful, users stick around, they engage more.
Okay.
And more engagement, well, that naturally creates more and better opportunities to show relevant ads down the line. So AI improving the experience builds a stronger foundation for the ad business, even if it's not an immediate revenue driver itself. It's about that ecosystem.
Got it. Okay, let's switch gears then. Google Cloud. This is where they're battling it out with Amazon, Microsoft, the enterprise cloud space. How does cloud make its money?
Primarily two ways. First, consumption-based fees for the Google Cloud platform. So companies pay for the computing power, storage, networking they actually use.
Pay as you go.
Pretty much. And second, subscriptions for Google Workspace. That's the suite of tools like Gmail, Docs, Sheets, Meet for businesses.
And AI is big here too, right? I saw Gemini mentioned a lot.
Oh, absolutely central. They're really pushing their AI capabilities in the cloud. They talk about AI-optimized infrastructure, their development platform called Vertex AI for building AI models. And yeah, they're big models like Gemini.
How is Gemini being used in Google Cloud specifically?
They're positioning it as kind of an AI assistant. For developers, it helps build and deploy AI apps faster. For cybersecurity teams, it's pitched as a tool to help find and deal with threats.
Sounds powerful.
It does, but you have to remember the competition here. AWS, Azure, they're giants. The 10K is very open about the significant resources Alphabet is pouring into cloud R&D, building data centers, hiring salespeople. It's a really high-stakes area.
Okay, and the third piece, other bets, the experimental stuff.
Exactly. This is where they put their long-term, maybe higher risk, but potentially high reward projects. Think Waymo, self-driving cars, Fairly Life Sciences, ventures exploring new frontiers.
Do they make much money now?
Currently, the revenue from other bets is relatively small compared to services or even cloud. The report says it's mainly from some healthcare-related services and internet services within those bets. The key thing to understand is the time frame and the risk profile. High risk, high reward. Some might become huge, others might not pan out, and again, often in very competitive fields.
So looking across all three services, cloud, other bets, AI, seems to be the common thread, the big focus everywhere.
Without a doubt. It's mentioned constantly in the 10K. It's in the infrastructure, it's the models like Gemini, it's being integrated into products like Search with AI overviews. They even highlight deep research projects like AlphaFold, using AI for protein structure prediction. It permeates everything.
And forwarding all that AI must require massive infrastructure investment. You mentioned data centers. The report talks about TPUs too. What are those?
Yeah, the investment is huge. Capital expenditures are way up, mostly for technical infrastructure. TPUs are tensor processing units. They're custom chips Google designed specifically for machine learning and AI tasks.
Ah, custom silicon.
Right. Designing their own chips lets them optimize performance and, crucially, efficiency for the massive AI workloads they run. The report even notes efficiency gains in their data centers when running AI overviews, so those investments are paying off.
And it all ties back to their mission, being helpful.
They frame it that way, yes. Using AI to help increase knowledge, health, happiness, success for users. And they also make a point of emphasizing responsible AI development guided by their AI principles.
Okay, that's a great overview of the business structure and strategy. Let's get into the numbers now. The financial highlights for the year ending December 31st, 2024. Big picture. Revenue growth looked pretty strong.
Very strong. Total revenues hit $350 billion. That's up 14% from $307.4 billion in 2023.
14% on that scale is significant.
It really is. And interestingly, if you adjust for foreign currency fluctuations, what they call constant currency, the growth was actually 15%. So the underlying business momentum was even a bit stronger than the reported number suggests. Currency headwinds held it back slightly.
Right, exchange rates can mask underlying performance sometimes. What about regionally?
On that constant currency basis, EMEA grew 12%, APAC was up 13%, and other Americas saw really strong growth at 20%. But as we noted, the reported figures for APAC and other Americas were a bit lower because of those unfavorable exchange rates.
Okay, so $350 billion in revenue. What about the cost side? How much does it cost to generate that?
Cost of revenues increased naturally. It went up to $146.3 billion from $133.3 billion the year before.
But as a percentage of revenue?
Ah, good point. It actually decreased slightly as a percentage of revenue from 43% down to 42%. That suggests some improving efficiency, which is positive.
What's included in that cost of revenues?
Key components are traffic acquisition costs, or TAC, basically what they pay partners to drive traffic to Google sites and apps. That went up to $54.9 billion.
Okay.
And then other cost of revenues covers things like data center operations, content costs for YouTube, hardware costs. That rose too to $91.4 billion.
Makes sense. What about operating expenses further down? R&D, sales and marketing.
R&D expenses increased, which you'd expect given the huge focus on AI and innovation we talked about.
Right.
Sales and marketing, interestingly, was actually down slightly, $27.8 billion compared to $27.9 billion. As a percentage of revenue, it dropped from 9% to 8%.
Any reason given for that?
The report doesn't elaborate much on S&M specifically, but general and administrative expenses saw a big decrease, down to $14.2 billion from $16.4 billion. That was only 4% of revenue, down from 5%.
Wow, why the drop there?
The report mainly points to lower charges for legal matters and also lower employee compensation costs, linked to having a lower average headcount during the year compared to the previous one.
Okay, so revenue up strongly, cost of revenue growing slower than revenue, some operating costs actually down. What did that do for the bottom line? Profitability.
Big increases. Operating income was up significantly for both Google Services and Google Cloud. And the final net income figure, a really substantial jump to $100.1 billion for 2024.
$100 billion.
Yeah, up from $73.8 billion in 2023. That flows through to significantly higher earnings per share for investors, both basic and diluted.
Impressive numbers. I did notice the tax rate went up, though.
It did. The effective tax rate climbed to 16.4% from 13.9%. The main reason cited was a one-time adjustment in 2023 related to some IRS rule changes, things concerning foreign tax credits and how companies have to account for R&D spending for tax purposes.
Ah, okay, a tax rule nuance. We also touched on the big infrastructure spending, capital expenditures. That really ramped up.
Hugely. CapEx jumped to $52.5 billion in 2024. That's way up from $32.3 billion in 2023.
And that's mostly the AI infrastructure, servers, data centers.
Exactly. The report is clear that's where the bulk of the increase went, building out the technical backbone to support growth, especially for AI. And because they're spending more on equipment, depreciation expenses also increased, up to $15.3 billion.
Even with all that spending, how did their cash flow look?
Still very strong. Operating cash flow for the year was $125.3 billion. That shows the core business is generating a massive amount of cash, giving them a lot of flexibility.
Let's quickly touch on some specific advertising metrics they shared. Paid clicks on search were up, and cost per click too.
Yes, Google search and other paid clicks rose by 5%, and the average cost per click advertisers paid went up by 7%.
What does that combination tell you?
It generally suggests a healthy core search ad business. More clicks mean more user activity, and advertisers paying more per click usually indicates they're finding those clicks valuable for generating business.
And on the network side, where they place ads on partner sites.
There, the number of impressions actually decreased by 11%, but the cost per impression went up by 10%.
Fewer impressions, but more expensive ones. Maybe a shift towards higher quality placements.
That could be one interpretation, yes. Focusing on more valuable ad slots rather than just volume.
And lastly, on financials, the balance sheet snapshot. Cash was down, but property and equipment way up.
Correct. Total cash, cash equivalents, and marketable securities ended the year at $95.7 billion, down from $110.9 billion. That reflects where the money went into property and equipment, which grew to $171.0 billion net value, up from $134.3 billion.
Okay, so a year of strong performance, significant investment. How are they planning to return some of this value to shareholders? That's always a key question.
A very key question. And there were some major developments here in 2024. The big one was initiating a dividend program back in April 2024.
A dividend from Alphabet. That feels like a milestone.
It really is. They paid out $7.4 billion in cash dividends over the year. It broke down to $3.5 billion for Class A shares, about $519 million for Class B, and $3.3 billion for Class C.
Is this a permanent thing now?
Well, they initiated the program, but the report emphasizes that future dividends aren't guaranteed. They're always subject to board approval each quarter, but it's a significant signal.
And they kept buying back shares, too.
Oh, yes, big time. The share repurchase program was very active. They bought back $62.0 billion worth of stock in 2024.
$62 billion.
Yeah, mostly Class C shares, $50.2 billion, and some Class A, $11.9 billion. They stress the program doesn't have an end date, and they aren't obligated to buy a specific amount, but it's clearly a major part of their capital return strategy.
So dividends and buybacks now.
Exactly. Both can impact the stock price, of course, and use up cash reserves. They also note the 1% U.S. excise tax on buybacks and the potential for that tax to increase in the future.
Okay, so looking beyond the 2024 numbers, how does Alphabet see the road ahead? What's their own assessment of the business moving forward? Trends, challenges?
They still expect to benefit from the general shift to an online world, more digital activity, but they do acknowledge that maybe the pace of that shift might slow down a bit compared to previous years.
In competition.
A huge factor. They explicitly mention increasing competition across the board, but especially, and this is critical, from AI developers and in AI generally. That's clearly top of mind.
Anything else changing the landscape for them?
Yes, the way people access their services, it's not just desktops and phones anymore. More diverse devices, different ways of interacting. This could lead to new kinds of ad formats, which they note might come with different, potentially lower profit margins than traditional search ads.
And we talked about the growth in non-advertising revenue, cloud, subscriptions, hardware. That trend continues, but with implications.
Right. Growing those areas is definitely a strategic goal, diversifying away from just ads. But the report is frank that these businesses, cloud, subscriptions, devices, generally operate at lower margins than their core advertising business. So, as they become a bigger part of the mix, it could impact overall profitability percentages.
And factors like international performance, currency rates, those remain variables.
Always. They mentioned potential fluctuations in revenue and margins due to how different international markets perform and, as we saw in the 2024 numbers, the impact of foreign exchange rates.
And the heavy spending on infrastructure we saw, is that the new normal?
It sounds like it, at least for the near term. They explicitly state they expect capital expenditures to keep increasing, primarily driven by the need for technical infrastructure to support AI.
So continued heavy investment.
Yes. And they also acknowledge the risks that come with that level of investment, particularly in new areas, new technologies like AI, where the outcomes aren't guaranteed.
It sounds like a complex picture. Lots of opportunity, especially with AI, but also significant risks and competition.
That's a very fair summary. The 10K itself lays out numerous risk factors for investors to consider. Things like their ongoing reliance on ad revenue, the intense competition, risks of new ventures not paying off, cybersecurity threats, which are always present, legal and regulatory battles, especially around antitrust and privacy, potential changes in tax laws.
They also mentioned stock ownership concentration.
Yes, that's a standard disclosure, but relevant. The founders and insiders still hold significant voting power, which impacts stockholder influence on major decisions. But overall, the message seems to be, we know the risks, we face challenges, but we're betting heavily on innovation, particularly AI, to drive long-term growth.
Okay, let's try and wrap this up then. We've taken a pretty deep dive into Alphabet's 2024 using their 10K. We've looked at how the business is structured, the key financial results, how they're returning cash to shareholders, and their view on the future.
Yeah, I think the main takeaways are pretty clear. One, AI is absolutely central now, massive investment integrated everywhere. Two, strong growth in 2024, both in the core ad business and importantly in cloud. Three, a shift in capital return, adding dividends to significant ongoing share buybacks.
But also challenges.
Definitely. Intense competition, especially in AI and cloud, the lower margins in growing non-ad businesses, and the ongoing regulatory scrutiny. It's a dynamic environment.
So maybe a final thought for you, the learner, to chew on. Alphabet is clearly all in on AI. It's reshaping their products, their infrastructure, everything. How do you think that balance between pushing innovation, keeping users happy, and, making a profit, how will that evolve in the next few years?
That's the multi-trillion-dollar question, isn't it?
It really is. And what does it mean not just for Alphabet, but for the whole tech landscape and for all of us using these services every day? Something to definitely keep an eye on. Thanks for joining us on this deep dive.